I did a little tea leaf reading on macro if you guys want it. I have some charts. I'm going to just give you a little rundown of, because I went and look, we used to talk about these things when we were doing a lot of forecasting going into this cycle. But so here's like a couple of really interesting observations. So the first one is, when you look at this M2 money supply, look how much it's actually shrunk. Now, why that's interesting to me is that you have these two forces that are opposing each other. One is we have these huge deficits. So we're technically still, frankly, issuing a lot of money, right? But then on the other side, we have QT. So when debt rolls off, we're not reissuing it. And the balance of that is still a really constructive thing where now you can see that, M2 has materially started to shrink. And I think that that's a really positive thing, because now what that does, it combats inflation in a good way. Unfortunately for all of us, it hurts financial assets, which is not so good. I think we've all felt that pain, but the reality is that that's been working. So then, Nick, if you go to the second chart, so what you see now is like, we are in a really decent place with inflation. And if you think about what's going to happen over the next 6 months, it's mostly in the bag. And meaning, we talked about this before, but there's a lag effect on a handful of components, specifically rents, which when you roll them into this inflation rate, you're going to see it really, really turn over very quickly, right? So we know that inflation is falling. It's going to fall even more. The second thing, Nick, the third chart here is you can see that now validated in these 10-year break-evens. Remember, this was the chart we used to look at when we were like, holy mackerel, something's going to break. In November of 21, I think we probably should have just sold everything we had in November of 21. We didn't do it, but the point is now we know. And what you see here is the 10-year break-evens are also telling us, okay, guys, we're going to be in a pretty decent place. And so I think the setup is basically the following. There's less money in the system. That's a positive. Nick, if you show the last chart, there's more money on the sidelines. And this is just a picture of, look at the amount of money in money market funds. 6 trillion and growing. So that's a really positive sign, which is that money will need to find a home.
Once rates drop.
No, even just now, because you're gonna be in a situation where, and I'll get to this in a second, but companies are now starting to perform because they've been able to rebaseline against very, very lowered expectations.
Right. And money managers have to do their job and deploy capital.
And that's something we mentioned, I think, last week. But this is now the beginning of the new fiscal year for the entire mutual fund complex. So that's trillions of dollars that have to get deployed, because even though you pay them a very small fee per year, you're not paying them to hold cash. You're paying them to make decisions and own assets. And then, as you said, Friedberg, the last part of this is now you introduce rate cuts, and that's a real accelerant. Now, more than likely, I think what that means is that markets are set up to do pretty well, equity markets specifically. And so I went and I said, well, how can we see some data that proves that this is happening? And what's amazing is if you look at the performance of what I would call the most risk-adjusted seeking companies, so those are tech businesses that have been absolutely hammered, what you see in the last month is they have gone just nuclear. Adyen up 30% in a matter of a week. DoorDash is up, 25, 30% in a matter of a week. Datadog up 30% in the matter of a week. These are the businesses that were just completely decimated. So what is all of this saying? I think what it's kind of saying is inflation is very much in the rearview mirror. Rates are going to get cut by the middle part of the year. The economy looks like it's going to be a soft landing. That is actually very beneficial for the sitting president. It's also good for equities. It's good for us. So it's really interesting, actually. I think we've had a fundamental kind of now change.